Hello, good morning. This is Megan Horneman, the Chief Investment Officer for Verdence Capital Advisors, and we're coming to you today with a special podcast. We have one of our investment managers here, Cornerstone Investment Partners. We have Rick van Nostrand. He's a senior portfolio manager at Cornerstone, and so nice to have you here, Rick.
Hey, great to be up here with you, Megan.
This is great. So I thought what we do today is, at Verdence, most of our clients and the people who listen to our podcast understand our view from a top-down. The top-down view is, what is the world doing? What's the economy doing? What's the interest rate environment look like? And what does that mean for how I invest? And we're lucky to have you because you look at it a little bit differently. So you guys look at it from what we call the bottom up. And the bottom up means you're actually in it, you're boots on the ground, in with the companies, looking at balance sheets, all the stuff that you're way too much smarter than I am to do. So we're going to have a discussion today for our viewers where we kind of look at things from different angles, from my view on the top down, and then what you guys are seeing really on the ground with these companies. So I got a bunch of questions to ask you. We'll start that way. I think that the most important thing is our view here at Verdence is unfortunately the economy is going to weaken. We don't think that a recession is something that we can avoid. The timing of it, nobody can perfectly pinpoint that, but we just see way too many dominoes stacking up. Sure. So if I had to ask you, what are some of the biggest risks from a macro level that you see that are keeping you up at night, or even some of the things that don't make any sense to you?
Well, the part that is maybe the things that keep us up at night are maybe the opposite of what keeps the market up at night. For us, being a value disciplined investor, it's the fear that other investors have, that other market participants have, that actually create a lot of the volatility we see on a day-to-day basis. And you see people trying to kind of guess the direction of the Fed by looking at second and even third derivatives, right?
Right.
And so those things lead to outsized price changes. And frankly, as a disciplined, value-based investor who's fundamentally driven, we get to take advantage of those. Now, there are some pretty severe dislocations that happen. And as we see those, then there's probably a better timing aspect of when we want to come in and start to build positions. We tend to do that over a diversified standpoint. But when we look at our companies, we look at them kind of across a cycle, like what's the earnings power across a cycle. And so when we see these kinds of, concerns of, everyone knew we were going to have a recession 18 months ago and the next 18 months, and then it didn't happen. And now we've seen a lot of outperformance because of that, right, out of different asset classes. The flight to safety is probably one of my biggest concerns, is that right now, I don't think there's a whole lot of individual idiosyncratic analysis of names. And so because of that, we're seeing large shifts of asset allocation. And when you have that happen, you get kind of on both sides. You get an entire class of stocks being bought up, and we've certainly seen concentration out of U.S. equity markets, especially in large cap this year. But in other cases, you see allocation away from other asset classes. And when that happens, we kind of talk about that as being the babies thrown out with the bathwater.
Right.
Those kinds of moves kind of get us really excited. So, am I waking up with nightmares or good dreams? I'm not really sure. They kind of, they're together.
Right. Yeah, and I mean, you guys, looking at some of these stocks, you guys have a long-term time horizon like we do with our portfolios and how we look at asset allocation. So I guess some of the dislocations that we're seeing obviously is from an interest rate perspective. We think that there's just way too much optimism that the Fed can come in and cut rates. The zero interest rate policy we were just talking about earlier, that's a thing of the past. That's something that really concerns us. And then what is the market pricing in too perfect of a landing, and whatever that landing may look like? Is it pricing in the perfection of what the Fed can do? Is it the perfection of the economy? One of the big things that we get concerned about is the consumer. The consumer is the biggest part of GDP, and what we're seeing is that they continue to spend money, and I don't know where it's coming from. You've got credit card debt that's growing at crazy levels. You have credit card rates that are at crazy levels. You have also delinquencies on the auto loans and the credit cards that are starting to rise. We saw that from some of the banks that were reporting earnings this week. Yeah. And then the savings from the pandemic is just completely gone. So, I'd love your thoughts on that just from a broad standpoint. Where's this money coming from, and what's keeping them spending?
Yeah, fortunately, so far, we've seen all those savings spent through. In aggregate. Now, what we think we've seen is a little bit of a bifurcation in the consumer. And so as high-end consumer has been propping things up, their savings are there, but frankly, they haven't really extended on credit. So far, credit rates, meaning credit default rates, we haven't really seen that manifest itself as much. There've been some fear of that, right? Names that have exposure to that, like like Discover and Capital One, and some of those that have exposure have concerns around what that credit book is going to look like. Banks have that same issue. But out of retail land, where we've seen some spending there, high end has held up pretty well, at least certainly through the second quarter. We'll see what the third quarter brings. But we have seen bifurcation on the other side. And so when you look at some lower end kind of side, we've seen shrink step up. For example, shrink was kind of the dirty word in a bunch of pre-announcements and earnings in the second quarter.
And there's just explain to our viewers what that is. I think I've mentioned it before, and we all know what we know what it is, but I don't think people know when they say what shrink is.
I'm not sure there's that. A lot of times we throw shrink around, and people do kind of the middle shortcut and say shrink is directly associated with things being stolen.
Right.
But really, shrink is have we lost control of that in the inventory? We don't know what happened to it, and so it could be spoilage. It could be other things, and so. But certainly, we assume there's not a difference in spoilage rates and those kinds of things. Then the operant kind of deviation here is that there could be, actual shrink, meaning things coming out the back door, employees doing that. And then you ask, well, what is driving that? And some part what drives that is when people are under more financial distress than they might. There's just that marginal piece. And these shrink rates, they're not huge, but they directly hit the gross margin, directly fall through the bottom line. And so we've seen some underperformance at a lower end consumer. And so I'm not pointing to it as a stock selection aspect for those names, but it does give you kind of an indication about what's happening to some of those consumers that they feel the need that shrink becomes an option for them.
It's unfortunate. And I did read some earnings reports recently about the higher end. There's some of the companies on the higher end are starting to see not a complete fall off in spending, but a bit of a slowdown in whether it's some of the higher end restaurants or things like that. So we continue to think it's something that is either just doesn't look good ahead. Something's going to happen. The consumers are going to have to pull back. There's just so many, I think, challenges for them. But to get back to the interest rate environment, which is another challenge for consumers. We just mentioned about credit card rates, but they're feeling it in the housing market as well. I mean, the housing market is just, unfortunately, a disaster right now. But from the interest rate environment that you and I discussed, we think the Fed is higher for longer. Yeah. In our view, and this is that everybody has a different one, we think the Fed probably has one more in them, and it probably will have to do with the volatility we're seeing in the inflation numbers. And if it is November, if it's December, that doesn't really matter to me. Even if it's January, we still think there's another one in for them. But what do you see, from a business perspective? Are they factoring in this higher for longer, or what are some of the steps that businesses are doing to take to factor that in?
Yeah, I mean, I think fortunately, at least the companies we've been looking at, and I'd point even just more broadly, but certainly we as stock selectors, look at this acutely to see what our company's exposures are. More broadly, companies have really thought through this. In large cap land, only about 15% of debt is actually floating rate. And so when we had very low interest rates, a lot of companies refinance. They refinance for longer periods of time. So average maturity out of large cap land is also about 7.8 years. So that's way out there. And small cap land is more like 5 years. And those effective rates are pretty darn low. So, the piece for those companies is if you didn't refinance, then you've got a wall of debt that's coming. And certainly, some of the stats you shared with me point to this debt. But that is something that's idiosyncratic, and looking at those names of those who didn't go further out on that maturity scale and lock in lower rates. So the question is, and this is when you said a lot of people think we're going to come to lower rates, that's not been a price that's in the equity markets yet. And that people are saying, well, this same people who are buying, houses now with 30-year mortgages at a 22-year high or whatever it is, are hoping that they get to refinance that, right? And so I can buy now, I'll refinance later. And I think that same kind of message is being applied to companies. Well, these companies, it'll be okay because they don't have to refinance until 2027. Well, higher for longer, you probably are going to have to refinance at much higher rates. And so when we look at that, where it's important for us to understand where we see debt maturities for our companies. And I think it's really an important aspect of financial and fundamental analysis in names at this point.
So question for you, it's regarding interest rates, there's a lot of talk about that Magnificent Seven, and we didn't have it on our sheet, but I know that we've talked about it before. So the Magnificent Seven, let me know if I forgot any: Amazon, Alphabet, Tesla, NVIDIA, Microsoft. What else am I missing? The other two?
Meta and Alphabet.
Meta. So these are 7 companies that, to your point, their PE valuations are very high, and in higher interest rate for longer, that's something that you shouldn't see. You shouldn't see PE valuations that high. So what do you see those Magnificent Seven doing compared to some of the other companies that you mentioned that may not be reflecting that?
Yeah, I think it comes down to that long-term discount rate. So we look at 30-year treasuries, right? And why have 30-year treasuries had one of the worst years ever? And it's because those long discount rates have come down so much, or I shouldn't say have gone up so much, so that's hit the prices. These long duration assets are very similar, right? And so those names in the Magnificent Seven that are producing much of their profitability in the future, so you think of a Tesla and Amazon, someone like that, then that growth is something that has to get discounted back. And those future years, frankly, as the discount rates go up, are worth less and less. So we wouldn't actually lump all the Magnificent Seven together. We actually have exposure to a couple of them, and those are names that are producing a great deal of cash flow and profitability now. And so those prices, those PEs aren't quite as high. Those EV to EBITDAs aren't quite as high. And as we bring back that discount rate, which we do in our valuation work, those equity values aren't impacted as much. But certainly, as we look at these names that have all their profitability on the come, then we have a much higher uncertainty, much higher discount rate we have to associate with those. And that's ultimately something that's got to reconcile itself.
Yeah. Unfortunately, I think it'll be in the market. We call it a valuation correction.
It's got to.
So, jumping to, we had talked a little bit before about this with what's going on in the Middle East. We're looking at higher energy prices, and unfortunately, it's interest rates higher for longer, and also energy prices higher for longer. So, from my view, the biggest risk with higher energy prices is to the consumer. So it's just another headwind for the consumer. But what do you see businesses doing? What are they doing differently? We've had a big shift in energy production and everything here in the U.S. The push to green energy. What do you see businesses doing to set up for that?
Yeah, boy, they're at the macro level, there are at least 2 major kind of themes unfolding. One is what I call kind of the erosion of Pax Americana, right? This idea that America breeds peace, and that peace premium keeps price stability and keeps prices down. The second side of that is then a shift in our own energy transition and where capital allocation goes. And so Western companies are allocating more capital to energy, green energy, and less to fossil fuel replacement, which then shifts that marginal producer to state-owned enterprises like Saudi Aramco that have, shall we say, political ambitions, for $80, $85 oil to meet kind of sovereign levels. So at the company level, so that seems to be a structural element that's there. Our question then is, how are companies dealing with it? And I think the good side of this is that, U6 unemployment has been so low for such a long period of time that in our company's planning, that capital labor mix question is a huge one, right? And so how do we make those kind of allocations? At 3.8% or wherever we've been kind of for now a very long period of time, the solution to just pull the lever and hire more and more people hasn't really been on the table since kind of 2020, really. And so we've seen now higher levels of capital allocation into basically increasing productivity. And so that, I think, is one element. I think we don't, not at the venture level, we don't think as much about artificial intelligence, of course, but we are seeing artificial intelligence coming in. There's many good reasons to believe that could be kind of the next step up for actually increasing efficiency. And I know people think about it as being very disruptive, but it's somewhat evolutionary. I go back to, I'm a computer engineer by training back in the 90s. So I grew up kind of with the internet even before it was, quote, the internet, before there was a browser or anything. And, at the time, people kept asking, well, what's the killer app? What's the killer app for the internet? What are people going to use it for? And,
Look at it now.
look at it now.
Right.
It became really, the killer app was efficiency. It was flow of information, that seamless flow of information. And so when you think of kind of the theory of knowledge in that, we've got the flow of information, we have data, but now what we're talking about is how do we take the analytics and ultimately draw, insight out of it. And so what we've done is we've put ourselves awash in data through internet and connectivity and all those kinds of aspects. And so the natural evolution is for artificial intelligence for companies and for people and for governments to be able to pull greater levels of insight and knowledge out of that flow of that right now is just a den. So, so I think that's the part that's kind of on the come that we're continuing to see. I have good friends who are leaders in some of this aspect, and they've, if you listen to their work, they see it as being at least as transformative as the internet has been.
Yeah, and from our side, just looking from the top down, I think it will help with some of the structural challenges we have with the labor market.
Yes.
That is an issue, and that's unfortunately an issue for the Fed because they're looking at the unemployment rate, and it may not be the best thing to look at. So let's turn it over a little bit. I have a couple more questions for you, but they really have to do with the kind of refinancing and this interest rate environment. So the refinancing wall that we've seen when I say a refinancing wall, that means a significant amount of investment grade companies that have to refinance debt in the coming years. Plus we're seeing, the small businesses, we talked about that, having high rates, and then we've seen bankruptcies rising. Yeah. From our view, given that environment, we think that the credit markets are still too expensive. And it's a shame because if you look at the absolute yield on corporate bonds, it's very attractive. But the reward you're getting for taking even that little bit of risk is just still near historic lows. So that doesn't make sense to me. That's one of the things that keeps me up at night, because what we often see with credit is spreads will blow out. And it's not like a short, small type of rise. They'll blow out and then they'll contract. So just your views on that. I'm not sure if you agree with me on that being too expensive, or if you have any thoughts there.
No, we agree with you very much so. There's some very good work out by a company we follow, Verdence, does some work and they look at kind of bankruptcy rates, exactly like you said. And just kind of recalling one of their graphs, in 2021, we went from 20 bankruptcies now to 60 on a trailing 3-month basis. If you were to extrapolate that out, then that kind of costs of high yield debt should go from about 4.4% to 7%. And so to your point, there's, we're 20 basis points, 230 basis points wide of where we ought to be if you just looked at kind of the one-to-one on that. And certainly we've not seen that get moved across, double B, single B, any of these kind of measures. We haven't really seen a step up yet. And a high yield, we certainly haven't seen it. So that manifests itself in the equity markets as well. And so, what we're actually kind of hoping for is ultimately that mark. And so what happens to get that mark so that we do get a sell-off, a price correction in those names? That'll lead to lots of opportunities in equity land, which, frankly, one of those things that wakes me up and I get excited about. But I think your aspect of there is that, yes, it is mispriced. People are being too kind of sanguine about what actual default rates are going to be. And a good part of that has been self-selection out of our companies, right? We look at our companies, look at Moody's. Moody's looks at their percentage of total debt that's rated kind of double B or above. And guess what? That's trended up over time. And part that's rated single B and below has trended down over time. And a good part of that has been capital allocation and a lot of these companies self-selecting away from, I don't want to get these any kind of higher yield. There's a lot of cash flowing into private capital, private debt. Let me go and access that. Really highlights the importance of doing solid due diligence into the capital allocators there.
So the other thing, and this is the only political question that we can get into, is the deficit, the government. This is a big issue, and the fact that interest rates continue to rise, the net interest cost for the government, by what we see, the estimates are that will exceed what we have to pay for our debt. What we spend on the defense budget, which at this time is not something that we want to cut, it will exceed that by 2028. What do you see as far as the outcome from that? Is this austerity in our future? Because austerity, we saw the last time, created several years of really weak economic growth.
Yeah, so I think you have kind of hope that it's two levers and that there's both taxes and austerity, right? And not to get political about it, but we've got to address both sides, and it's not something that we can just close our eyes to. It's become quite large, $32 trillion. Yeah.
And it keeps going up, and we have less and less buyers now with the Federal Reserve embarking on the unprecedented experiment, I would say, of quantitative tightening.
Yeah, absolutely.
So then my last question, and this really brings it all together. The way that we invest our clients' money is we really believe in active management. So active management comes in two different levels. It's active management as in as Verdence, what do we see from the top down? What are the asset classes we want to be in? What's the environment for interest rates? What's the inflation environment? And then we rely on really good managers to come in and have, from a active management perspective, to be able to pick the companies. I mean, that's what you guys are really good at. So what can you tell our listeners to why for so long active management everybody said it's never coming back, it's dead, it'll never be here. The past couple of years, we've seen the importance of active management. The beginning of this year, we saw the Magnificent Seven leading the entire index. And even through the third quarter, the Magnificent Seven are making up 85% of the S&P 500's total return. Yeah. So what would you tell the listeners why active management in this environment, not today, not tomorrow, but for the next couple of years, 5 years, is so important?
Yeah, and I think active management is important across, and certainly the due diligence you do as asset allocators into finding good active managers. It's part of where our partnership with you is so important. For us, then, is in taking that mandate from you and looking to apply for our own capital allocation in places that we believe are mispriced. Mispricing is the key point to that. And the mispricing is, yes, a lot of these names are up a lot. They've continued to be up. But are they really going up because of their own fundamentals? Or are they going from just kind of blind capital allocation where there's kind of a momentum chasing? And so that flight of capital to follow those things that have outperformed, and momentum has continued to be a really strong aspect of outperformance and what has outperformed over the last 3 years. That aspect ultimately leads to wider and wider dispersions between valuation, between these names, and ultimately that has to reconcile itself. Certainly the only time we've seen anywhere near this level of dispersion in valuations has been all the way back into kind of .com era. And I'm not saying that's the only time, that we've seen large dispersions, but ultimately these things do have to reconcile themselves. Ultimately, either these very high expectations have to come through or they won't. And so one aspect with active management certainly that leads to outperformance is if we just even look at an equal weighted S&P against a cap weighted S&P. And in the third quarter, we did see a bit of that return. And so that's a very kind of tactical element, but we think that active management is going to be important on the backside of this, because a lot of what you and I just talked about was price adjustments. And when those price adjustments happen, it's not even just a matter of what you own, but what you don't own. And so avoiding those places where you have abject price adjustments that lead to permanent value destruction or certainly value impairment over the next few years, that's going to be a key point to outperformance. We don't think you get that with passive allocations, because the passive bundle, you buy everything. And to your point, if you buy everything right now, you're putting 85% of it into, a few names.
Wow. It's been great talking to you, and it's great to talk to somebody who isn't a momentum chaser and sits and be patient like we are. Sometimes we'll be early, sometimes we'll be late, but in the long run, it doesn't really ever, I think, make any sense to chase asset classes or stocks or anything that are just basically being driven by momentum.
Completely agreed.
Well, it's been great talking with you today, Rick. Did you have anything else that you want to ask me or questions or anything before we wrap it up for our listeners?
No, I would just say that I've really enjoyed your podcast. I'm on Spotify following you, and it's been wonderful to follow you and have my own kind of ear to what's going on in the markets.
Oh, it's great. It's great always having you guys up here. So, all right, that's all we have today. If you guys have any questions or comments, please feel free to reach out to podcast@verdence.com. Thank you.
Thank you.
Thanks.